the focus of this is more so on the passive investors, the investors that are looking to invest in multifamily from a limited partner standpoint, or however it's structured. But basically, they're not the operators; they're the ones providing the cash, the equity. What should investors look for when considering investing in their first syndication?
So I'm going to skip right past the obvious of look at the board and the managers and the operator and their work experience and track history, and go straight into the distributions to see how is your money going to make you money. You need to pay attention to the preferred return and see if you're already entitled to compensation through a preferred return that's paid before other distributions. Okay, and that can be helpful. Second is to look and see what is the return of capital profile for this investment. So of course we have return on capital, that's your distributions, whether that be a preferred return or common equity where you just get your pro rata distribution. In a refinance or a sale, particularly in a refinance, and even in some circumstances with cash available for distribution, what is considered a return of capital? It's very, and the reason I brought up the preferred return is it's very important to consider how the return of capital is predicated so that you know if the operator can pay you your capital contribution back where you'd otherwise expect it in a return, which would reduce the amount of return you get from your preferred return. Okay, so that was a lot of return words. But what we're saying is this: if you invest $100,000 and you have a 7% pref, you make $7,000 per year on that. Okay. If the operator can send you capital contributions back that reduces your capital account, your 7% would be assessed on that reduced capital account.
Yeah.
So if they sent your return of capital back of $50,000 and you may have thought it was distributions or otherwise, your 7% is now only predicated on that $50,000 and can wildly change that investment. So just see, most of the time you want to see that return of capital happen at a refinance or a sale. Okay, but after you have met certain distribution thresholds, like an average annual return, internal rate of return, or cash on cash return.
Mm-hmm. And I guess further to clarify that, if say you're looking to deploy $100,000 and you want to make sure that's at work for the next 5-7 years or whatever the projected timeline is, they do a refinance event on year 3 and they decide to pay you 25% or half, make it easy. So 50 grand back. Well, now your overall return is affected. It's not that that's a bad thing. It's understanding that like possibility and how that flows within the operation. So what you're saying is investors should have a firm understanding of how that's going to impact their returns if that happens. Is that the plan? Talking with the operators, hey, what do you plan on doing when you refinance? Are you going to give us our money back, or how does that play out, right?
That's spot on. You just want to know, because look, operators could put crafty things in there where they could just pay your capital contribution back early, and then they're responsible or obligated to a lower return. And you want to know that, so you know that there's not an event that they can cash you out basically when you haven't realized the full potential of the investment that you were expecting or anticipating on the front end.
And then this is where having a good attorney on your side, like yourself, can help make sense of the devil's in the details. And it's not that operators are, maybe trying to do anything malicious or anything like that, but it's just you got to understand it. I mean, those are the terms. Those are how they're going to be operating and abiding by. That's what you should expect. And how is that going to affect your expectations?